Hi, and welcome to Chapter 1. The purpose of these lecture videos is to introduce each of the chapters. In future classes, the lecture it's going to be far more in-depth, but this is just a review of Chapter 1, which you learned in your other courses, such as Intro and Intermediate Financial Accounting. The majority of the slides I'll be using are the property of McGraw-Hill Education. If I've inserted my own slides, I'll advise you of that. However, the audio on these videos is mine. So please note that you're not permitted to download these videos and post them on any sharing sites. You're in a professional program. Please don't violate any copyright laws by posting either the videos, the slides, or the audio on any sharing sites. Note that this copyright notice will appear on all of my videos, but I'm probably not going to discuss it again except to quickly say this is my copyright declaration. For this chapter, I won't be omitting any of the learning objectives from the assessments in the course. Financial statements are used by external users to make resource allocation decisions, and that's decisions about money. Think about potential investors who are deciding whether to invest their money, or creditors such as banks or credit unions, and they're considering whether to loan a company money or not. The CPA Canada Handbook is what organizations use to develop their financial statements because many laws in Canada require its use. The handbook provides not only guidance on how to report transactions and events, but also what to report. It includes not only the standards, but also explanations and guidance. If a transaction or event is not addressed specifically in the handbook, then we have to look at the conceptual framework. That's called first principles. This is the document found at the front of Handbook 1, right before IFRS or Part 1. Basically, the conceptual framework is where authoritative bodies go when they're developing new standards. It literally frames, like we're talking about framing every standard in existence, and it's used to develop all the new standards. The conceptual framework is not considered a standard in and of itself. It can't be used to override an existing standard. That's not the purpose. Instead, it's the foundation of all the existing standards. It's going to be the foundation of any new standards that we adopt. All accounting policies can be traced back to and are supported by the conceptual framework. And that's why the conceptual framework is so important. The conceptual framework is actually made up of 8 separate chapters. You can see them noted on this slide. To summarize the chapters into kind of the main ideas, we can see that they include the objective of general purpose financial statements. Why do we produce them in the first place? The qualitative characteristics for useful financial information and the underlying assumptions. And then also in separate chapters, the definitions, recognition, and measurement of all the elements of financial statements. And we're talking, of course, assets, liabilities, equity, revenue, expenses, gains and losses, and other comprehensive income. Everything we do under both IFRS and Aspy requires professional judgment. The standards in Canada are principle-based. This means that the handbook provides the principles of good financial reporting, but we as CPAs are required to take into account the circumstances and make the decision that will best meet the information needs of the users. As noted here, we use judgment to decide which policy to adopt, to make estimates, and to create the notes to the financial statements, which are critical so that the users of the financial statements can understand what the financial statements mean and how everything was determined. The handbook is divided into parts, as noted on this slide. You can see it's got part 1, 2, 3, and 4. The bulk of this course is going to be on part 1 and part 2, which is IFRS and Aspy. Note that we won't be focusing on part 3 or 4 in this course. The textbook in Chapter 1 really gets into the history of standard setting in Canada, which is interesting because it really shows how standards have evolved over time. At one time, the focus was on harmonizing our standards with the United States. But once we adopted IFRS, that changed dramatically. In Canada, all publicly traded corporations are required to follow Part 1 of the Handbook, which we call IFRS. Note that we won't be calling it Part 1 in the course. I'm going to simply say IFRS. And remember that when I say IFRS, I'm referring to Part 1 of the CPA Handbook. Historically, private enterprises followed the same rules as public companies. So in the past, we had something called GAAP standards, and that's generally accepted accounting principles. However, when Canada decided to adopt IFRS, a task force determined that requiring private enterprises to follow IFRS would be an administrative burden as well as a monetary burden, because IFRS has a lot of standards that do not help the users of the financial statements for private enterprises. Generally, private enterprises are closely held, meaning that they have very few users, and those users generally work in the business or they're closely connected to the business. So keep in mind that financial statements are produced to help users make resource allocation decisions. If making private enterprises follow IFRS doesn't help the users make the decisions that they have to make, then we shouldn't force them to use IFRS because it's actually not helping the users. This is why we have accounting standards for private enterprises, or Aspy for short. Note that private corporations are permitted to follow either IFRS or Aspy. Aspy is covered in Part 2 of the handbook, but we're simply going to call Part 2 of the handbook Aspy. Remember, private corporations have a choice between IFRS or Aspy. It should be noted that both public and private corporations issue shares, and therefore equity for both public and private corporations includes share capital. I mention this because often students are unaware that private corporations have shares, and that shares is part of the guidance or standards under Aspy. So I just want to make that clear right now because it popped into my mind and I just want it here up front so we're all on the same page. Keep in mind that the term GAAP, generally accepted accounting principles, is still used today, but it's now really an umbrella term that encompasses both IFRS and Aspy. So we'll say that corporations have to follow GAAP, and then we'll say that means they have to follow either IFRS or Aspy. When analyzing a case, note that for public companies, the case does not need to state the standard that they follow because all public companies have to follow IFRS. However, if a company is a private company in a case, then the case must indicate if the company is following IFRS or Aspy. Be sure you read your cases carefully because if you misread the standard that's being followed by a private corporation, you're going to apply all the standards incorrectly. You've already covered the differences between IFRS and Aspy in your intermediate financial accounting courses. You've actually been exposed to the differences between the two standards. However, as a review, the key difference, I think, between IFRS and Aspy is really the disclosure requirements. Aspy requires far fewer notes to the financial statements. If you look at public companies' financial statements, they'll often have notes to the financial statements which are 20 to 100 pages long. So that's like a major difference. Aside from note disclosure, there are some notable differences as you can see on this slide. For instance, IFRS allows the use of the revaluation model or the cost model to value long-lived assets, but Aspy only allows the cost model. Another example is development costs, which meet the criteria must be capitalized as an asset under IFRS, but under Aspy, development costs which meet the criteria can be either capitalized or expensed. Other differences include how income taxes are reported. IFRS requires the deferred tax method, but Aspy allows either the taxes payable method or the deferred method. So, as further noted on this slide, there are differences between the two standards. However, in other areas, Aspy rules are identical to IFRS rules. For example, the valuation of trade receivables, which we call accounts receivable, is identical under both standards. What I'm trying to emphasize here is that because there are differences, it's important to know which standards you're following when you're solving a question or solving a case. Note that this chapter also comments on not-for-profit organizations and the accounting standards which must be followed, as well as the standards for government, which is IFRS, or other government organizations, which follow either IFRS or the PSA Handbook. So PSA stands for Public Sector Accounting. The PSA Handbook provides a series of definitions and related guidance around various types of entities operating in the public sector and the accounting framework to be applied to these entities. Keep in mind that this topic, like not-for-profit standards, is beyond the scope of this course. So our focus will be on IFRS and Aspy in this course. Remember that financial reporting is there to provide information to external users to make resource allocation decisions about their money. They want to decide whether or not they will receive an acceptable rate of return on their money given the level of risk in the organization. They want information to really faithfully represent the financial conditions of the organization and the results of their operations. The quality of financial reporting is high if the financial reporting information they give is useful and reliable information for the external users. Obviously, if the quality of the financial reporting information is low, then the users are not getting the correct information that they need in order to make decisions. Financial statement analysis is used by external users in order to review, evaluate, and interpret a company's financial statements to see about the company's future prospects. So we use the historical information, or users use the historical information to make educated guesses on what they think will happen in the future. Financial statement analysis usually includes some of the following procedures. So first, we perform common-sized analysis and we interpret those results. So what does that mean? It means that we perform vertical and horizontal analysis. Vertical analysis is when each item in the financial statements is expressed as a percentage of a specific base. So that means that we will take all the items on the statement of financial position and we'll divide them by total assets to see what percentage of total assets it makes up. So we can also say, so when we're looking at assets, let's say we have trade receivables. We'll take trade receivables and we'll divide it by the total assets. And that will tell us that, let's say trade receivables makes up 10% of total assets. We'll also take, let's say, the long-term liabilities and we'll divide it by total assets. And you might say, well, why are we dividing it by total assets? And that's because we could divide it by total assets or we could divide it by total shareholders' equity and liabilities. We take the total liabilities and the total shareholders' equity, we add them together, which is equal to total assets, because assets equals liabilities plus equity. That's why we take everything and divide it by total assets. And so what does that do? Like, how does this help us? Well, we can then compare it to prior years in the same company, and we can see if there's a trend, right? Are trade receivables, accounts receivables going up? Well, then we can go to the income statement and we can see if the sales are going up. Because if sales are going down, but trade receivables are going up, that tells us that we're not collecting the cash from our customers. And that's a dangerous message that is being communicated to the users of the financial statements who are deciding where to put their money. So that's what vertical analysis is in the statement of financial position. In the income statement, vertical analysis is when we take every single item on the income statement and we divide it by total revenue. If I take, for instance, operating expenses and divide it by total revenue, it'll tell me what percentage of total revenue is being consumed by my operating expenses. So how much is it costing me to earn a dollar of revenue? We do the same with gross profit or gross margin, right? If we take the sales minus the cost of goods sold, it equals gross margin. If we take the gross margin and divide it by total revenues, it'll give us the gross margin percentage. Again, what we can do then is we can do trend analysis to see, is this percentage changing over time? If sales are going down and operating expenses are going up, we're going to see that in our vertical analysis. We can even do vertical analysis on the cash flow statement. We'll take the sum of all the three activities and divide each activity by that sum. So again, we'll show what percentage of cash is coming from operations, what percentage is coming from investing, and what percentage is coming from financing. That's vertical analysis. We would then also perform horizontal analysis. The best way to remember horizontal analysis is NO. That's N-O-O. So that means new minus old, all divided by old. So if sales are $1,000 this year, and they were $900 last year, we would do new, $1,000 from this year, minus old, which is 900, all divided by 900. So that is 100 divided by 900, which is 11%. That indicates to us between last year and this year that sales increased by 11%. We would do that for all the line items. So keep in mind that vertical analysis can be compared between corporations. So we can do a vertical analysis on one corporation and on a different corporation, and we can compare the percentages as long as they're in the same industry. Horizontal analysis can only be done within the same company. So we'll take 5 years of financial statements and we'll do horizontal analysis for all 5 years. And that will show me the trend over time. Are sales increasing or decreasing? Is accounts receivable increasing or decreasing? Is accounts payable increasing or decreasing? Are the amount of dividends paid increasing or decreasing? So we can do this kind of horizontal analysis to see trend over time. Once both vertical and horizontal analysis is complete, then the results, like I said, are analyzed to determine those trends. Is the change or the trend good or bad news? The next procedure in financial statement analysis is to review the accounting policies that are used by the company and the estimates they used to ensure that they're appropriate. This is where the notes to the financial statements are critical, because it really involves comparing the company's policy to other companies in the same industry. Are they using the same policies? And if they're using different policies, is there a good reason for the difference? If there is no good reason for the difference, then the next procedure in financial statement analysis is to adjust the financial statement so that the same policies are used. We can't compare two companies if they're using two different policies and there's not a good reason for the two different policies. It really is intended to make the statements comparable between different companies in the same industry. Note that adjustments have to be made in a particular order. We start with adjustments to the income statement, then the statement of financial position, and then the cash flow. And I'll be honest, cash flow rarely is changed because cash is cash. Any changes to the income statement and the statement of financial position are unlikely to change the cash flow statement anyway. The next procedure in financial statement analysis is to calculate ratios for one or more periods. So keep in mind, we've done all the vertical and the horizontal. We've reviewed the financial statements. We've made any adjustments to the policies to make sure that they're comparable. Then we're going to do ratio analysis. And our main focus is on the current ratio, the debt to equity ratio, the return on asset ratio, and the return on equity ratios. In order to properly assess these ratios, we then have to compare the ratio to a benchmark, which would include things like ratios from prior periods in the same company, ratios from a competitor, ratio from the best company in the industry, ratios to industry averages, right? Because if they have industry averages for these ratios, we want to compare that company that we're thinking of investing in to the industry averages, or we might compare it to a rule of thumb. So we know, in this industry, generally the, debt to equity ratio has to be 1-to-1 or 0.75-to-1 or whatever it is, right? So we have a rule of thumb. We might compare it to a rule of thumb. We can't assess ratios unless we have a benchmark to assess them against. We can then interpret the results of the analysis to answer questions such as how and why have the ratios changed? How does the level and trend in these ratios compare to other companies in the industry? What facts explain the differences? These financial statement analysis procedures really allow the users, the external users, to decide if they will increase, decrease, or maintain their level of investment in the entity. There is a section on the analysis and interpretation of financial statements at the end of every chapter. It's there to remind you that different accounting policies affect the financial statements in different ways. The different accounting policies will have different effects on the ratio calculated to analyze the entity. It's important for us, the preparers of financial statements, to understand how our recommendations with regards to accounting policies will affect the analysis and interpretation of the financial statements by the external users. If we don't understand what our recommendations are causing with regards to ratio analysis, because don't forget, the financial statements are going to be published. They are literally there to help the external users. So if we're making recommendations, then we need to be able to tell the client, we're making this recommendation, and this is how it's going to affect your major ratios. Be sure to explore the impact of different accounting policies on both the numerator and the denominator of the ratio. For example, a change in a policy may increase liabilities and decrease revenue. So this is when the client has recorded revenue and it should have been an unearned revenue. So it's going to increase the liabilities and decrease the revenues. Depending on which ratio you're looking at, this change in policy could impact either the numerator and the denominator, only one of them, or both of them. Okay, so it's really important that when you're making recommendations and the client knows that the external users are going to look at the debt to equity ratio, in this case, when we look at debt to equity ratio, if I increase liabilities and decrease revenue, the debt to equity ratio is going to have a double whammy. Both of those things are going to cause a worsening of the ratio because they affect both the numerator and the denominator. It's important you understand that. In this course, you'll be asked to go beyond just calculating the numbers. Like when I'm talking about financial statement analysis, I'm not telling you, hey, just tell me how the client needs to record a held for sale asset, right? So you tell me this is how they have to record a held for sale asset. Previously, they were just leaving the asset on their financial statements, but it turns out that they should have reported it as a held for sale asset because it meets all the criteria. And so we're going to transfer it from being just a regular asset in the property, plant, and equipment. We're going to make it into a separate line item on the statement of financial position as a held for sale asset. This is going to cause a write down on the income statement. So it's going to reduce the net income, and it's going to cause a reduction in the value of the asset on the statement of financial position. And it's going to move it from being a long-lived asset to being a current asset. All of these things are going to impact the ratio. So it's great that you can tell me how to do the transaction or the event, a held for sale asset, but now you're going to have to go further. You're going to have to tell me what that means for the ratio analysis and what impact it might have on the external users of the financial statements. You really need to think beyond just the number, the calculation. You at this point in accounting, you need to go beyond the numbers. All right, that's it for chapter 1. Thanks so much for listening to this lecture.